Unlike other types of investing, dividend investors actually embrace short-term dips in share price as it can provide a larger margin of safety and the chance to acquire stocks with higher dividend yields, which means more cash flow. With that being said, the 3 stocks we're talking about in this video are just plummeting in share price, leading to dividend yields that are upwards of 60% higher than their 5-year average, making them potentially great buys for your portfolio right now. But before we get to those, in case you're new to the channel, my name is Ryne Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Anyway, moving on, the first stock that we have to talk about, guys, is Tyson Foods, ticker symbol TSN, who is just cratering in share price. Just in the last 5 days, guys, they really fell off a cliff right there, down 20% just in the last week, which brings them to a year-to-date loss of 23.25% and a drop in the last year of nearly 50%, and they're sitting right there at their 52-week low. So what happened to Tyson Foods and what caused this company's share price to come down so much? Well, they've had a handful of bad quarters, and that's what caused the huge drop that we saw earlier this week. In their latest quarterly earnings report, Tyson Foods missed on both the top and bottom line, with their earnings per share actually going negative, which is obviously no good. And to add insult to injury, they lowered their sales guidance for the rest of the year by a couple $2 billion, so they're anticipating more challenges ahead, and clearly the market did not respond well to the news. Overall, though, this sentiment towards the company has been pretty consistent over this last year, which is why we've seen Tyson Foods drop close to 50% in this time period. This is probably well deserved, though, because in all fairness, they have missed on the bottom line for the last 4 quarters in a row, so their track record of putting up good numbers hasn't exactly been great. In fact, I will admit their income statement is starting to look a little bit concerning. Here we can see that their gross profit has gone down every single quarter since October 2021, so about a year and a half now. And the same is true with their earnings per share, which, as we saw a moment ago, is now officially freezing cold, sitting below zero. Despite these poor numbers and this awful direction, though, is there still a case to be made for Tyson Foods as a buy? Well, it depends on how you look at it. Everything we've talked about so far could be looked at as a sign to stay away from the company and head for greener pastures, or you could see it as an opportunity to pick up a large and historically pretty stable dividend-paying company at an attractive valuation. And the valuation is actually pretty good. Seeking Alpha gives them an overall grade of an A-, and the PE ratio there, 11.61, really isn't too bad, but this is still 1.25% higher than the company's 5-year average, which is a bit perplexing considering how much the company has dropped in share price. Because the share price has gone down so much, we would typically expect to see the PE ratio much lower than the 5-year average, but in Tyson Foods' case, that's not what we're getting at all, because remember, the earnings per share is going down right there along with the share price. However, the other valuation metrics are looking a lot better. The forward price to book is 0.89, so they're currently trading below their book value, and the price to cash flow is also looking great, 7.35, nice and low in the single digits, and this is 33% lower than the 5-year average price to cash flow. And the dividend stats are still actually looking really good as well. In fact, they're looking better than ever, starting with the forward dividend yield, 3.78. This is getting pretty dang close to being what we would consider a high yield, and because the share price has come down so much, this yield is 61% above the company's 5-year average yield, so you're able to get a much higher cash flow return than at any other point in the last 5 years. And the rest of the stats are still looking pretty good as well. I mean, the 5-year growth rate's looking incredible, 12.3% across the last 5 years, and the dividend growth history is not too bad either, 11 consecutive years of growth. And so whether or not Tyson Foods is a buy right now, it's really tough to say. The valuation and dividend stats are both looking great and do indicate an opportune time to buy, but personally, the declining profits and earnings per share do concern me, and at this point, I would wait for that to turn around before starting a position in Tyson Foods or adding any more shares. Anyway, moving on to the second stock of the day, we're talking about UGI Corporation, which is a utility company whose share price has also completely fallen off a cliff. In the last month, this company is down nearly 14.5%, which brings them to a year-to-date loss over 22%. And then in the last year, they are down 21.3%, so most of these losses have come just in the last month. And like with Tyson Foods, UGI's drop in share price has also come as a result of their quarterly earnings report. Fortunately, though, their earnings per share is not negative, but it's still about 8% below what analysts were expecting, which is something many of you could probably take or leave. But possibly more notable is their revenue for the quarter. Although they were in line with guidance, their reported revenue was nearly 11% lower compared to this time last year. But even with all this, the company still announced a 4% dividend increase, which is always welcomed by shareholders and is a nice cherry on top to an already impressive dividend. Starting here with their dividend yield, this is sitting just under 5%, so they have a really nice high yield, and this is also about 58% above the company's 5-year average dividend yield. And the rest of their dividend stats are looking great as well. The payout ratio is smack dab in the middle, exactly 50%, with a 5-year growth rate that's really not too bad considering how high the yield is, 7.5%, with 35 years of dividend growth, which makes UGI Corporation a dividend aristocrat. And getting to the valuation, I think this is also looking pretty good. I mean, Seeking Alpha also gives them an A- overall, and the PE ratio is starting to get pretty close to being in the single digits, 10.5, which is 32% below the company's 5-year average PE ratio, so a bit of a steal there. And then the price to book in the trailing 12 months isn't too bad either, 1.25, which is also 35% lower than the company's 5-year average. Now, regarding whether or not UGI is a buy, I've got to say, I'm feeling a bit more confident with this one right now than I do with Tyson Foods. While utility companies aren't really known for their aggressive growth, they tend to offer a lot of stability for investors, and at least in terms of cash flow, this is certainly the case with UGI. And overall, if you're looking for another sleep well at night stock to add to your portfolio, which I don't think you can ever have too many of those, then I think UGI might be a great one to look a bit deeper into because the dividend stats and the valuation are both looking really great. And now moving on, this brings us to the third stock of the day. We're talking about Qualcomm, who just like the last two companies is sitting right near its 52-week low, and in the last month has really dropped off a cliff. It is down 13.85%. We can see it really fell off right here, which brings them to a year-to-date loss so far. Really not too bad, only 1.3%, but in the last year, they are down 21.6% as the entire semiconductor industry has really not been without its headwinds. More recently though, in the last month, once again, this dramatic drop in share price came after they reported earnings, and it looks like they just barely missed on the bottom line, which honestly, in my opinion, this is just a rounding error. It's really not that big a deal. And they actually beat on revenue estimates, which is good, but still showed a 17% loss in sales year over year, which is obviously not good. The company says they're continuing to see the impact of things like macroeconomic headwinds, weaker global handset units, and channel inventory drawdown. So basically, the entire world is out to get Qualcomm, and they'll probably continue to be affected by these issues, at least for the coming quarter, so it may not be much of a surprise if the share price keeps coming down, but I will say even right now, sitting near its 52-week low, it's still looking decently attractive. Overall, Seeking Alpha gives them a C+ valuation grade, but the PE ratio is 13.09, which I guess is a bit higher than the other two companies we've seen so far, but still, this is about 24.5% below the company's 5-year average PE ratio, so it's a bit discounted in that regard. And the forward price to cash flow is also looking pretty dang good, I will say, 10.82, which is 30% lower than the 5-year average. And getting into the dividend stats, the forward yield is sitting just below 3%, which isn't too bad. This is a pretty average yield, and its difference in relation to the 5-year average isn't nearly as impressive as the last two companies. And taking a look at the rest of the dividend stats, these are also just kind of looking okay. I mean, the payout ratio is nice and low, sitting under 30%, which is nice to see, but the 5-year growth rate is a bit underwhelming, only 5.6%, especially when compared to other semiconductor companies like Texas Instruments with a 15.6% 5-year CAGR, and Broadcom with a near 26% 5-year CAGR. And going back to Qualcomm, they do have a 19-year dividend growth streak, but overall, in my opinion, Qualcomm's dividend stats do leave much to be desired. Having said that though, this is all coming from someone who still holds Intel, so you may want to take that with a grain of salt. At any rate, Qualcomm is still definitely worth checking out, and there's no denying that all three of these dividend stocks are heading towards deep discount territory, just like the three stocks I'm telling you about in this video right over here. All three of these dividend stocks are also taking some pretty big hits in share price and could be good ones to add to your portfolio right now in the month of May. So click right over here to check them out, and I'll see you in the next one.